Good morning and welcome everybody. My name is Ariel Berezowski. I'm the head of Treasury at Point72. Today we'll be discussing topics related to uncleared margin regulations. But instead of covering the usual materials that we have all seen lately related to UMR, we wanted to take a step further into this topic, call it UMR 102. Our topics today will include both legal and operational considerations. That is, it is time to go live. So for today, HCL3 has put together a great panel of experts in the field that will help us onboard some challenging questions, some of which we might not have the final answers yet, but do help provoke some interesting conversations. We will have 45 minutes to discuss some topics with the panelists, and then leave 15 minutes for Q&A at the end. Throughout the presentation, we will present some polls for the audience to answer, and we'll provide the results as we go. All lines will be muted. If you have any questions for the panelists, please use the Q&A section provided by the app. At this time, I'd like to introduce the panelists themselves, starting with Ted.
Hi, Ariel, thank you. So my name is Ted Leveroni. I'm a senior product manager within the segregation and collateral business at BNY Mellon.
Thanks, Ted. And we also have Joe.
Thanks, Ariel. Yeah, hi, I'm Joe Spiro. I'm the Director of Product Management at Hazeltree. I've been in the collateral management industry for about 20 years, holding leadership roles at firms like Merrill Lynch, Deutsche Bank, BNY Mellon, Societe Generale. I've contributed to ISDA and other industry working groups on the topic of collateral management. And at Hazeltree, I'm focused on helping our buy-side clients to improve their collateral management process, to increase efficiency, reduce risk, and increase liquidity. I'm honored to be on this esteemed panel today and looking forward to a great conversation.
Thanks, Joe. And lastly, Poseidon.
Thanks, Ariel. So I'm Poseidon Retsinas, the founding partner of Hedge Legal. We're a boutique law firm which is focused on the negotiation of trading documentation. Prior to Hedge Legal, I was I've been in the industry for about 15 years, working at Clifford Chance in the derivatives practice, as well as at InnoCap, where I was heading up the onboarding and negotiation with counterparties. Our firm has been assisting firms assessing the impact of UMR as well as negotiate documentation. There's lots of great topics to get through today, Ariel, so back to you.
Thank you. So let's get started. So let's start with, point number one. Essentially, one thing we know at this point is that we got to pick a custodian. It doesn't have to be the same one between us and, the other party. So each one gets their own. But the question is, and this is for you, Poseidon, in your opinion, what should people look for in a custodian? There's plenty of, options out there. What are your thoughts?
Yeah, it's a great question. So I think the custodian question comes up very early on in the process. As soon as a manager knows that they're in scope for UMR, they've done the ANA assessment, they've realized that they're over the IM threshold of 50 million with at least one counterparty, and will probably be so at the time of their either phase 6 or phase 5 or phase 6 implementation. It's essential that they start discussions with custodians. If they've never worked with a custodian before, there's a bit of a learning curve to go up, both operationally, but as well as some of the legal documents that are needed to set this up. So I think it's really important that they start the process early. I recommend that they speak to multiple custodians to understand their service offering, both along the lines of, do they have Triparty, do they have third party, has this custodian been involved in previous phases, do they have experience, how are they in terms of their onboarding capacity to meet the deadlines for phases 5 and 6. So I think these are really important questions, as well as assessing what level of connectivity does that custodian have with the counterparty or the swap dealer that the fund will be facing. So there's also benefits to be had by using the same custodian or custodians that the counterparties are familiar with. If you're bringing in a custodian that they're not familiar with, that's going to take more time, and there may be even pushback from the swap dealer as to using them altogether.
Thanks. You mentioned a couple of keywords there, and generally some confusion out there on our experience. Like Point72 is a phase 5 UMR participant, and some of the results are coming in here, pretty divided. Most there's a lot of attendees are not hedge fund managers. The rest are phase 5 or phase 6 as well. But you mentioned two keywords there, and then there's been a lot of misunderstanding: third party and tri-party. The buy side has used the word Triparty for a very long time, but maybe it'll be interesting to really understand the difference. So Ted, you're a Bank of New York, there's more than anybody else probably out there. You can give us a little more color about the difference between Triparty, third party.
Sure. Thanks, Ariel. And this question obviously comes up a lot with us. We're one of the few custodians. There are others out there. We're one of the few custodians that offers both the tri-party and third-party model. What you'll find is most custodians or service providers offer one or the other. There's a couple out there that offer both, like BMI Mellon. So we're having this conversation a lot. And like you said, Ariel, the terms have been thrown around a lot. And I came from the buy side, and we always thought of tri-party as really what now we're calling third-party, which I realize it's confusing, but I think the industry now has settled on these terms, right? Third-party model is essentially a separate custodian account for every single pledging to counterparty pair. So if you're a hedge fund and you've got one legal entity that's in scope and you have 5 dealers, you're going to open up a full custody account for each one of those pairs, and then you'll post to that. And there's a wrapper around it. For UMR, there's a regulatory wrapper around it. The ACA has to be compliant. There's default processing that goes to it and the like, but it is essentially a custody account and not a lot more. There's not a lot of other functionality in that account. You instruct, you will determine what collateral is going to be moved, how much is going to be moved with your counterparty. You'll instruct your existing custodian or whoever's holding the assets to deliver it into the custody account, and then you'll instruct to have it sent back, and then the secured party will release it. But the third party custodian doesn't check eligibility, doesn't check haircuts, doesn't check concentration limits and the like. It's simply an account that holds the assets and holds them safe. The tri-party model is a little bit different, both in structure and then certainly in level of services. The way the tri-party model works is you create one custody account. But that custody account is the pledgeor's own assets. They can put the assets in there, and that's essentially what we might call a long box, where those assets are sitting there unencumbered, still fully owned by the pledgeor. But what the tri-party agent then does is they add shells that attach to that single custody account, and each one of those shells represents a counterparty pair. And when the counterparties agree to the overall required amount, then they would message the tri-party custodian. And the tri-party custodian has already within their system captured all the eligibility criteria, all the haircuts, all the concentration limits, maybe some optimization preferences. And then the tri-party service provider or custodian will then move the appropriate amount of assets either from the long box into the individual shells, or if there's over collateralization, the collateral that's segregated is greater than the required amount, then the custodian will pull assets from those shells back into the long box. So basically unsegregate those assets. So the third party model that described it, for anyone that might have have experience being a 40 Act mutual fund where they segregate VM, looks very, very similar. The tri-party model was born from the tri-party repo model. So if anyone has experience in tri-party repo, they might be used to this model. And so those are the two models essentially that the industry has settled on for the segregation of assets. The third party, just a custody account, and the tri-party adding in allocations, optimizations, eligibility checks, haircuts, and the like. I think you're on mute, Ariel.
So you're in the front row of the action here, right? The poll suggests that about 60% hasn't decided yet which model to use. The rest is 50-50 down the middle. What have you seen at Boney?
It's interesting. I'm surprised to see that poll, and I think it shows that we've got an educated audience, because I'll tell you, going into phase 1 through 4 were primarily banks, broker-dealers. They almost universally, save one that I know of, went tri-party. It's automated, it's easy, it's efficient. It's a model that the sell side fully understood and had used, like I said, in the repo market. So they went that. When phase 5 came along, obviously a lot of buy side firms, we went into this thinking it would probably be 80-20, 80% third party because they're buy side, 20% tri-party. And we were surprised to see it was really almost 50-50, which actually is what the poll showed. So it tells me that people have kind of been educated on it, because what happened was, going into phase 5, the knee-jerk reaction still on the buy side was, oh, I'm going to go third party, but tell me more about this tri-party stuff. And as they educated themselves about the model, how it worked, some of the efficiencies, some of the assumptions around cost that may or may not have been accurate, a lot of them realized that tri-party model actually worked with them when they thought that it might not. So traditional asset managers, I know traditional asset managers that have gone tri-party, definitely third party as well, but tri-party as well. Insurance companies, I know some that have gone both. Hedge funds, I know some that have gone both. So you really need to go in an educated way to make this determination. And there's a lot of assumptions you may make going before you learn more about the two models and speak to custodians that can offer them both, that you want to really challenge those assumptions. And then make the determination in a fully educated way. You may fall on third party, you may fall on tri-party, but what you think going in may not be what you end up with.
So Joe, from your side, right, you do a lot of servicing, for a lot of people that have to manage collateral, and you see custodians, not only but also additional custodians. What's your experience? What are you seeing? How is the simplicity to basically put in place a tri-party? I know a lot of people are afraid, oh, tri-party, this seems like a bank thing only, it's complicated. What do you see on your side?
Yeah, no, I think that's a really, really interesting observation from Ted, that we were expecting to get a large percentage, a very, very large percentage, the overwhelming majority in phases 5 and 6 elect for a third-party account, and maybe that's not playing out quite as strongly as we had thought, which in my opinion is great. I've always been a big proponent of the tri-party system. This conversation has been going on for a lot of years, and I think a lot of people, just because of the familiarity aspect with the third-party model, because this is what people have always used, may have just had a knee-jerk, yes, third-party, that's it. But as you learn more about it, you realize that it's actually a lot more efficient to go with the tri-party. So it's nice to hear that people are keeping an open mind about that. The other thing to consider, and Ted sort of alluded to this, depending on which one you choose, whichever one you choose, there's going to be a big impact on your operational process, because the operational processes for the two are very different. If you have a third-party account, it's sort of the traditional model of collateral management that we've gotten used to, where the secured party makes a call, I'm calling you for X amount, and then the pledging party says, okay, I agreed to X amount, and here's what I'm going to send, and they define a particular asset, whether it be cash or a bond or whatever the case may be, and then they wire that particular asset into the custody account. In the tri-party model, it's completely different than that. So Ted sort of alluded to it. The custodian is the one in charge of selecting the asset based on an optimization ladder. They'll consider the price and the haircut, etc., and they'll allocate those assets accordingly. So the only thing that the two parties involved in the margin call have to do is agree on the amount. So that amount is called an RQV, required value. And both parties have to communicate to the custodian, the tri-party custodian, what that RQV is, so that the tri-party custodian can match it up and move the assets. Big difference, because in the third-party model, you as the pledging party need to know what assets you have available. You have to track prices, you have to track eligibility, you have to track haircuts, and you have to have systems and processes in place to track all of those things so that you're pledging the right assets. Tri-party model is simpler because you only have to communicate a number, but one thing that is not always considered, that is a very important consideration, is even if you as the pledging party are not selecting the tri-party model, if your counterparty is selecting the tri-party model where they are the pledging party, whether your dealer is pledging to you, both parties have to communicate that RQV number to the custodian. They have to match it from both of them. So even if you are not selecting a tri-party model, you still have to have the ability to calculate the RQV and communicate it to the custodian in a manner which they're willing to accept, which is often SWIFT messaging. It's a big consideration that people sometimes lose track of.
So let me just follow up on that one for a second. You mentioned SWIFT messaging, and probably a question back to Ted. Is there a possibility of doing tri-party without SWIFT? I know a lot of people don't have SWIFT.
There is, right? So be my well, and I don't think that we're unique in this, as we try to make things easy for our clients, right? So the larger firms or firms that use administrators and the like, they typically can use SWIFT, and that's the industry standard, right? We also have a portal, and I think most custodians do. We have a portal that you can go in and you can manually make RQB instructions, as Joe said, or movements, pull down reports, all of that. But then also linking to industry infrastructure is something that I think is important for any major custodian. Is something that we take seriously at BNY Mellon, and so linking to creating links to firms like Hazeltree, right, that have a group of clients that can benefit from that link. So you don't need to, from the client side, it's great. They don't need to create the new Swift messaging, and they can enjoy still an automated messaging component because they're on the right system. And then for us, it's great because we don't have to work with, as much as we like working with our clients, we don't have to work with onboarding all of these clients because they're on a system. It's already integrated with us, already tested with us. We know those Swift messages are good. So for us, it's still Swift. For the client, it's not, and it's taken care of by a provider. So, there is that middle ground between creating your own Swift messaging and logging on to portals, which for low volumes is fine. But I think as the volumes go up, you'd like to enjoy that electronic connectivity that's automated in a Swift format. So, a number of different ways to do it. And it's something that, like I said, we take seriously at BNY Mellon to try to make sure that we integrate with the entire ecosystem. And it just benefits everybody.
Oh, all right. So let's move on to the next topic. So we pick our custodian. We have picked our model. Next, the big question is, who do we need to paper with? And obviously, you have all your counterparties that you need to go after. And back in the days when it was free to establish any ISDA, you will go to a counterparty, you will paper every single entity they had. Probably you never did a trade in the last 10 or 15 years with some of those counterparties. So Poseidon, you're on the front row of the action on the legal documentation. What's your thoughts on this? What would your recommendation to a client on how to approach the massive amount of documentation that is going to come their way?
Sure, that's a great question. It's a loaded question, but I think the discussion point, having discussions with your counterparties is paramount. Just as much as you want to start talking with your, choosing a custodian, approaching all of your counterparties, particularly those that you have a larger trading relationship with, is going to be really important. So for those that are under the 50 million threshold, and again, this is across the counterparty group. So if you're dealing with multiple affiliates at one counterparty, that threshold gets applied across all of them or aggregated. So you need to essentially figure out which ones are potentially going to be in scope. Those ones that are in scope, and as you say, where they have multiple affiliates, you need to figure out where those trades are with the different affiliates. And you probably will not need to repaper with all of those affiliates. You'll probably only need to choose a smaller subset, maybe one of them. And so that's an initial an assessment that needs to get done. I think more importantly than that, though, is managers. We've seen managers be strategic about how they're approaching UMR, both from the portfolio composition perspective, but also as to how they spread their business across their counterparties. So what I mean by that is on doing business with counterparties perspective, if let's say we have a manager that has 5 counterparties, and when they look at and they project into the future what the IM requirements are going to be, let's say 4 of them are going to be over the 50 million threshold or close to it. They would have to repaper with all of those counterparties. By changing the mix, either by concentrating more business towards a smaller subset, let's say 2 out of the 4, you can reduce the number that you'd have to paper. So you can concentrate your business at fewer counterparties, and so only have to repaper with a smaller subset. Or the opposite can also be true, where you can put in place more trading lines, other ISDAs, spread your business across more counterparties, and that way potentially never get over the 50 million threshold with any of them. So I think that's something that should be looked at very early on to be ready for that, and it can be really beneficial. The other thing is on the portfolio composition. Let's remember that a fund can fall into and out of compliance depending on what their aggregate average notional amount of uncleared OTC derivatives is over certain periods of time over the year. So there's certain ways that a portfolio can be modified so that you actually lower your total outstanding notional amount of uncleared OTC derivatives. You can do some portfolio compression, or you can even move, if possible, can use other products. Can you move to cleared OTC? Can you move to futures products? So to actually get out of essentially get out of being subject to the rules altogether. So I think that's another step that should be done as early as possible to see if there's any way to work around those as possible solutions. Another point on this counterparties, on the point with counterparties is this 50 million threshold. So going forward in the future, this is a threshold that needs to get monitored. If you're under the 50 million threshold, let's say you're at 25 million with a counterparty, you're not going to need to repaper. The regulators have stated that if you're under the thresholds, you don't need to repaper. As you approach those thresholds, then you will need to repaper, and you should repaper, because if you go over it, you may have to put trades down, or you won't be able to continue trading with that counterparty. So the point about monitoring is just to be aware of where you are with the different thresholds, have a conversation with the counterparties. The swap dealers are not going to want to paper somebody that's at 20 million on the threshold. It's a lot of work for them. It's probably not worth it. If you're at about 30, 35, or 40, then they're probably going to say, yes, let's paper this, and let's be proactive. So that's another point in the discussion to have. So we're 3 months. We're 2 months away from implementing phase 5, which is really soon. Phase 6 has a little bit over a year. I think it's really important for phase 6 firms at this point to start getting ahead of this. I've heard from some phase 6 firms that counterparties are not ready to engage with them. They're focusing on phase 5. That is probably true, and it certainly is true, but I think it's still really important for phase 6 firms to be at the front of the queue. There are going to be a lot more entities in scope for phase 6 than there were for phase 5. It's estimated it'll be around double. And each phase has seen more and more entities in scope. So the number of entities that were in scope for phases 1 to 4 was somewhere around 50 or 60. We've seen probably about 100 here, and there's going to be probably at least 200 in the next phase, based on various estimates that we've been hearing. So I think getting in there quickly, being proactive with counterparties, and is really important, so that you're not at the end of the queue come September 2022.
So let's touch base a little bit on a lot of information there. Touch base on the amount of people coming in. Phase 5, obviously, 0.72 have seen a lot of the activity going on with the brokers, and they wanted to be done with phase 4 before they pay attention to us. But a very good point that you mentioned, Poseidon, is like you want to be in the front of the line. There's a lot of documentation to be done. You want to attract the attention of the broker dealers, but not necessarily everything can be negotiated. There's a lot of things that are established by the rules, and there's on the custodian side, for example, right? They need to deal with everybody. So sometimes there are some limitations of what is humanly possible. So Ted, back to you now is, what approach is Bonnie taking? What's the approach of the industry as they had to tackle hundreds of disagreements themselves? It's like on my side, it is overwhelming. We have a person dedicated to negotiating UMR. We have people, lawyers dedicated to negotiate UMR, and this is just us. But you guys face everybody, so almost everybody. So what's the approach as Bonnie is doing here? Can you give some color to participants and some recommendations as well?
Sure. So first of all, it's not hundreds for us; it's thousands, right? Because for every large dealer that's a client of ours, we're facing off, and we have to deal with the ACH for their pledging, even if their pledging counterparties are not pledging via BNY Mellon. So the lift right now is like nothing I've ever seen, and I've been in the industry for 20 plus years. A couple of things that we've done. The first thing we set aggressive deadlines when we needed the documentation. And honestly, there was pushback on that, and we got a lot of questions. Do you really need this much time? Why is it that your deadlines are March or February for certain documents, and other custodians are later? But we have those deadlines for a reason. It was because of the volume of documents and the work that we were going to need to do to onboard all of these clients. We also set up a receivers concierge group. So one of the things to remember is BNY Mellon, we were a very large participant in servicing the phases 1 through 4, all the broker dealers. So there's a huge number of their counterparties that we have to onboard that we don't know as a client. So there's a lot of work that has to be done there from the client. Joe mentioned the RQV has to be sent by both counterparties. This isn't something that most buy-side firms have done in the past. Buy-side firms are also going to want reporting. They're going to need to get that. That requires, it's not a heavy lift, but it is a lift nonetheless. We have to support it. So we actually set up a receivers concierge group. So anyone that's on that's receiving collateral via BNY Mellon, whether they're using this or not, I should plug this. They should email us at marginseg@bnymellon.com to get this information to get set up, right? This is important. We're telling our brokers, we publish that with ISDA. We're trying to make it easy for receivers to set up, but we've set up I don't want to call it a task force, a team to handle just receivers. These are non-pledging clients. Something we also did is we standardized our ACAs. So this was an interesting point, and there was a lot of discussion about it internally, because phases 1 through 4, we allowed the typical negotiate however you want the ACA, and that worked. Because we had so many ACAs going in, what we did is we actually created a committee of buy-side representatives, sell-side representatives. And by the way, not just one type of buy-side, right? We realized the buy-side isn't a monolithic entity, so we had all different types. So I invited insurance companies, traditional asset managers, pension funds, and hedge funds and the like. And we took a look at the ACA that we had for phase 4. And we said, all right, how do we make this essentially more friendly to everybody, easier for everybody? And what we came up with was this non-negotiable ACA, but with options. And so we have a body of an ACA where there's terms that are locked down that have been tested by the industry, and we say, okay, these are good for typically for everybody. Might not be ideal for anybody, but good enough for anybody. And then at the end of the ACA, we have options you can check. So if you want the right to notice, the right to contest a default notice, you and your counterparty want that, check the box and you're good. You want a delay period on a default notification, check the box and you're good. So we ultimately, what we did was we came up with this document that could very quickly be executed by our counterparties. Now, truth be told, a lot of counterparties struggled with this in the beginning. I understood why, because they've never been told, especially large clients, never been told, no, you can't negotiate these items. But almost universally, once they started to get these executed, they found that it actually was a really good decision, because it got to the point where every one of their counterparties has already seen and agreed to these documents dozens of times. And so if you're coming in near the deadline and you go to your dealer and you say, oh, I'm going to pledge via BNY Mellon, they'll say, you know what, we already know that ACA. We don't have to devote a whole lot of time figuring this one out. We've agreed to it 80 times just last month. We can do that again. And so that's something that we also did. And I think that helps. Other things like outreach, education, and the like are things that I think we've taken seriously. We had to do it because of the tri-party, third-party discussion that we had earlier. But those are some of the big things that we did within our shop to try to make phase 5 go as efficiently as possible, given the numbers of new firms that were being pulled in.
Appreciate the caller. One more topic also from things that Poseidon mentioned is, how do we find ways to try to sell, below the thresholds? Some of the things that are out there as well is, there's different ways of posting collateral, right? Poseidon, you're the expert on this matter as well. And Joe, you have seen a lot of activity as well on this side. So I'll start with Poseidon, then we'll go with Joe. Poseidon, if you want to go through the different type of, collateral methods. And Joe, I would like to get your color as well of, what are people doing? What are people electing?
Thanks, Ariel. Listen, I'm gonna pass this one off to Joe. Joe, if you want to go first and discuss the margin approaches, I feel like we want to get you into the action here. So go ahead.
Sure. So yeah, the margin approach is interesting in relation to what Ted was just discussing, because Ted was discussing how in order to get everything done, we really need to standardize. Well, this is one aspect where the industry has introduced something that's the opposite of that. It's not standardized, and it's a term that didn't actually exist before in earlier forms of the CSA because it wasn't a relevant concept before, right? We have the notion of independent amount and initial margin. Well, isn't that the same thing? It was always, those terms were used interchangeably to mean exactly the same thing, similar to tri-party and third party, and now they mean something different. Used to be, a broker based on their risk appetite would charge certain clients and certain trades with certain clients an extra added amount, often expressed as a percentage of notional, but it could be done a number of ways as a buffer above and beyond the mark-to-market they need to post. People called this independent amount. People called this initial margin. Now with UMR, the regulated amount that must be posted according to the regulations is referred to as initial margin, so that that amount from the broker based on their risk appetite and their own discretion has been called independent amount. Two different concepts. And it's an important one because if you're subject to independent amount today, pre-UMR, and you'll be subject to initial margin post-UMR, what do you do? So the new CSAs have introduced this concept of the margin approach, where the industry kind of settled around 3 different approaches. There are pros and cons of each. So the distinct approach basically means that if you're subject to independent amount, you continue to pay it. And then if you're subject to initial margin, well, now you're going to pay that too. So you're essentially paying both. As you can imagine, the dealers who are currently receiving the independent amount would be in favor of this method because it meets the regulatory requirements and they continue to get use of those funds. From the buy side's perspective, it's probably a little less appetizing to have to pay both. The greater of method is another approach that's used, which basically says you look at the amount of the independent amount, you look at the amount of the initial margin, you see which one is greater, and you post that amount in its entirety into the segregated account. From the buy side's perspective, this is great because they're posting the least amount possible, and operationally it's efficient because you're only making one flow of collateral into one place. From the dealer perspective, if they were getting that independent amount posted to them directly previously, they're going to be losing the use of those funds, so it's a little bit less ideal. A bit of a compromise is the third one, which is called the allocated approach, which essentially says you look at the amount of the initial margin, the regulatory amount, and that needs to be posted to the segregated account. You can't get out of that. But to the extent that the independent amount exceeds that, you would take the amount that it exceeds the initial margin and allocate that back to the broker. So that's sort of a meeting in the middle. Important to note that some buy-side parties don't post their independent amount directly to the broker. They post it to a segregated third-party account. And in that case, from the broker's perspective, it doesn't really matter whether you choose allocated or greater of. It's very similar from their perspective. So you might as well go with greater of in that case, so you only have one flow of collateral.
Thanks. So just in interest of time, I'm going to move to the next topic. But first, some answer from the poll. It seems pretty divided down the middle. Some people electing the distinct approach. That one's a little surprising to me, just as Ted said. Joe said, you're double posting collateral. Probably on the buy side is the least preferred one. But obviously, different people make different choices. What works best for each company. So now, we have a margin approach. We have a custodian. We know who our counterparty is. Now it's time to post collateral. And that essentially is defined in the ECSs, or equity collateral schedules, electrical collateral schedule, I'm sorry. And one of the topics has been, hot topic with the sell side is, can we post cash? The answer is yes, the answer is no. Ted, you're one of the, if not the biggest custodian out there. What's going to take? Cash is eligible, it's not eligible, it depends on the regulation. The definition of promptly is always out there. Thoughts?
So the answer is yes and no, right? I mean, I think that's almost the best description of where I think the industry lies on cash. Now, the thing to remember is, and I'll speak U.S. right now. So I think most of the audience is from the U.S., but I'll touch on Europe as well. But according to the regulations, cash in a vacuum is eligible collateral. It's part of the list of collateral that's eligible under the regs. Now, the problem is that under the regs, you have to segregate the collateral. And custodians don't actually physically segregate cash. They hold it in an omnibus account. And so the view from the regulators and the industry, because they understand the way custodians hold cash, is that segregation of cash doesn't work. So the regulators have said, okay, the cash has to be transformed into something else that is eligible. So what you have basically is, depending on it comes down to be really labeling of something, but you have cash that can be potentially, if the counterparties agree, can be used as a transfer asset. It can be delivered if that's what you want, and the counterparties agree and the custodian can support it, but it can't be ultimately held as what is collateralizing the deal, the exposure, the required amount. And so what most firms that we've talked to have settled on is money market funds. Now, not all money market funds are eligible. And in fact, there is a significant issue that I don't know we're going to get into today, but I'm happy to talk about other times. ISDA's talking about it, SIFMA is talking about it, like is how I use money funds cross-border when there's multiple jurisdictions that have that are regulating an entity. But in the US, for instance, money markets can be used if it's Treasury only and there's no SEC finance or repo in that money market fund. So there are a subset of money market funds out there that are eligible collateral, and typically what we've seen is firms saying, all right, if they agree the cash can be delivered, but money markets are what's going to be held, they put into their collateral schedule essentially that, and the firm gets a call for $1 million, they send $1 million to their counterparty. If it's a third-party model, cash is delivered into the third-party account and then transformed. It's automatically swept into a money market fund. So now what's actually collateralizing the exposure is that eligible money market fund. And when they want the return of that collateral, they agree to a return. The money market fund is liquidated to the proper amount, and cash is delivered back. So cash just becomes really how the delivery occurs, but not the but what's ultimately segregated is a money market fund, and that would work with treasuries or any other eligible collateral that the firms agreed to. But money market funds is so easy to do with cash, right? So that's typically what we see. Now there are other impacts and determinants to this, because remember, just because something is okay per the regulations doesn't mean that you're automatically allowed to post that. There's still a negotiation between the counterparties on what ultimately is going to be agreed to and delivered. And so you can't go to your counterparty right now and say Ted Leveroni said cash is okay, so put it in the CSA. It doesn't work that way. And we see as a service provider so many eligible collateral schedules, and we have discussions with our clients and alike. And I'd say very few of them are accepting absolutely everything that's eligible per the regs, right? Firms have to be comfortable with it, because you ultimately might get stuck with it if there's a default. There might be balance sheet impacts. There might be just processing challenges. So ultimately, there's that negotiation after you get the full universe of what is eligible. And like I said, for cash, technically it's eligible, but it's not segregatable, and so it has to be transformed into something else.
Thank you. So we can see from the results of the poll that different participants are looking to post all different kind of assets. Cash is one of them. One interesting thing about the ECS is as well that we look at a typical CSA. You see cash, and you might see money market funds. Sometimes you might see treasuries. When it comes to an ECS, it could have pages and pages long of eligible collateral, right, that could go in there. And not necessarily have to be the same from one side or the other side. It could be completely asymmetrical, not only about what is eligible, also what the haircuts that would apply for each party as well could be asymmetrical. So question for you, Joe, now, what are you seeing as holder of a lot of this, collateral schedules? What is the market out there?
Yeah, you're right. The eligible collateral schedules, especially from a UMR perspective, are typically defined separately. Now, as Ted mentioned, both parties could have the same custodian, and you could have the same eligible collateral schedules, et cetera, but it's not necessary. It's not required to do that. So if the documents are negotiated separately and executed separately, there's every possibility that they could have completely separate schedules, especially if they're with different custodians. But I think what we have heard is that, even if some participants on the buy side aren't planning on posting the wide and vast array of various types of collateral that their counterparties on the sell side might be pledging, a lot of time they negotiate the same eligible collateral schedule. Basically, it should be even if the haircuts aren't the same. At least the asset population would be the same, and then they just don't necessarily use it. I was actually encouraged by that poll that just came up. It's not all cash. Historically, collateral for mark-to-market purposes has been mostly just cash, and will probably continue to do so. But for IM, it's going to not be all cash, partly because of what Ted just discussed about the regulations, but also just using the assets that you have on hand to be more efficient. And so, firms need to have systems and processes in place to track their assets, the eligibility of the assets, the price, the haircut, et cetera, and then be able to post them, especially in a third-party environment, in a triparty environment, you have to post the RQV so that the custodian can do all that. But it's interesting to see that it's going to be a lot more than just cash going forward.
All right, so we have a custodian. We know which model we're going to approach, what type of collateral we can pose. The question then becomes how much. And generally, when you do calculations mark to market, people look at their books and records. That's something not really complicated to do. Initial margin, people have different methods to do it. Let's call it independent amount, just to follow Joe's lead from before. But when it comes to initial margin, calculating the SIMM itself, right? It is not necessarily as simple as the models, definitely could be replicated. But the question is, what are people doing? So Joe, once again with you, what are people doing? Are they buying a system to calculate SIMM? Are they building it themselves, getting regulatory approval? Doesn't matter if it's here or there, same question, afterward for Poseidon, do you have any guidance about what people should be doing and just be careful out there, the small letter of the law? But let's start with, market color. What are people doing? Are they buying? They're replicating themselves?
Yeah, it's a great question, and sometimes this is the start of the conversation. I think this is a great panel because we're covering the 102 topics, as you said, and not necessarily starting with this one, but it's an important one because how much are you going to need to pay for initial margin is obviously the meat and potatoes of the whole issue. What we have seen from buy-side firms is, frankly, it will vary from one jurisdiction to the next. If you're going to calculate the SIMM, you need to first calculate your sensitivities, which some buy-side firms are not prepared to do. So it could be an outsourced solution where you can hire one of the solutions on the market to calculate your sensitivities for you and then calculate your SIMM. There are plenty of services out there that would be willing to do that. In certain jurisdictions, that's absolutely mandatory for all participants. In the US, it's a little bit different because, and Poseidon can talk about this a little bit more, but the buy side is not necessarily subject to the rule that requires them to replicate the model. And so in that case, what we have seen a lot of US firms doing is electing not to independently calculate, but rather just to accept the dealer's number. There's precedent for this. If you think about, the futures market today, a lot of FCMs will calculate an initial margin in the form of span or something else, and they issue those margin calls. There are not many parties on the market who are independently replicating span to verify the futures margin call. And so a lot of US firms have taken the same approach to SIMM. Hey, I'll let my counterparty calculate it, and I'll go with that number. It's certainly a lot more cost effective to do it that way. And then the downside is that you give up some of the management of your own risk. Also, as I mentioned, it's definitely different from one jurisdiction to the next, depending on the regulatory regime. I know that there is some industry advocacy out there to potentially change that, but let me throw it over to you, Poseidon. What are you seeing as far as the differences from one regime to the next?
Yeah, thanks, Joe. I think you touched on it. You touched on it there. The main difference is that the rules in the US apply to the sell side firms, and the buy side firms are being drawn in by implication. The regulations don't directly apply to the buy side firms. It's a very different scenario over in Europe, where the rules there apply irrespective of whether or not you're a buy side firm or a sell side firm. And so the buy side firms find themselves in a situation right now, and there is advocacy going on, and hopefully there will be some relief granted, but they do find themselves in a situation where that if they have elected to use SIMM, they need to be subject to a certain governance of using SIMM. So governance as to documenting why they've selected SIMM and the appropriateness of choosing SIMM, as well as monitoring it and testing it on their own end. So, and finally, even in some jurisdictions, there's a pre-approval process needed where managers will need to seek pre-approval from the regulator to use SIMM. So it's a very different landscape with respect to the use of SIMM for the US firms and firms in the EU. And so yeah, that's one of the big differences. Hopefully these gaps will get closed. There is an initiative to try and harmonize some of the cross-border impact of these rules. But it's still a work in progress.
Thanks. So let's close it out with what's the road ahead. So most phase 5 people should be at this point in time be in the final stages of dealing with documentation. If they haven't started, I would highly recommend that they seriously, get on it. But for phase 6, let's start with you, Poseidon. What's your recommendation? How fast do people need to get started with this? Let's say September, that we're done with us phase 5, and the brokers will pay their attention, and Boney will pay their attention now to phase 6.
Yeah.
How fast do they need to
Well,
get?
I mean, the start. So the start of the documentation process, I would separate that from the start of the actual UMR process, which I think, if even for phase 6 firms, if you're not already starting, you need to have already calculated ANA. You need to have already been, in my view, estimating what your IM requirements would be. You need to have already started making decisions. Will you use SIMM or not? But just strictly with respect to documentation, once you've figured it out, I think best practice is to probably budget about a year to get it done. It seems like a lot. It actually, even as I'm saying it, it seems unreasonable. Like, why would it take a year to agree to legal documentation? But from the experience of the previous phases, it in fact has taken that long. So the documentation that's needed here is a lot more complicated than in, for instance, for VM rules, which were rolled out about 4 years ago, where there was a big scramble in the industry. Let's update the CSAs, and it got done in time, and there was a scramble there. Here, it's more complicated because of the triparty, or the three-way nature of it, that you have to say that you have the custodians involved. And anyone who's ever worked on any of these documents, as soon as you have 3 parties involved in a negotiation, it makes it 3 times as hard to get something agreed. And the back and forth time can really lag. So to Ted's point earlier, the fact that the Bank of New York Mellon has standardized the ACA, I think that has gone a long way to speeding things up with respect to that. There are some pros and cons there, as Ted said. Some firms are not that comfortable with the non-negotiable nature of some of the points, even though I think that the major issues were covered in the elections, in those ACAs. So I think most firms can probably get comfortable with that. So I would say, get started as quickly as possible, figure out which counterparties are in scope, get the documents moving quickly. There's multiple documents needed here per set of counterparty. You're looking at four or 5, maybe even 6 documents per relationship. Whereas, you'd usually think, well, it's just, an ISDA CSA. Well, now it's more. There's the ISDA CSA, there's the ACAs on both sides of the equation. There may be some other security documentation that's needed depending on the jurisdictions. And the custody account, which depending on third party or tri-party, will also have some of its own nuances. So there's having said that, I think it's key to get started as quickly as possible.
Thanks, Ted. Your thoughts?
Yeah, I think Poseidon really hit it. Just a few added comments, right? The way I view it is actually there's 3 pieces to this, right? There's education and decision making. There's your bilateral documents, so getting set up with a custodian, all the documents there, and then there's the trilateral docs, right? The ACAs, things where, like Poseidon said, you need three parties to do. The education, it's already starting, right? I mean, if you're watching this webinar, you're starting the education process, and you're not doing it too early. Trust me, this is where you want to start educating yourself. Tri-party versus third party. What are the operational impacts? What are the costs? Who can do that? A bucket, are you going to be in scope as education? Bucket, how are you going to manage the thresholds as education? Those things you can do, and there are service providers, and there's vendors, and there's industry associations that can try to help you with that today. You can also start your bilateral documents, because these are like said, you've got to set up your custody account. If this is the first time you're setting up a tri-party segregation model, there is new documents that you're not used to: security agreements, GCAs, global collateral, global custody agreements, all that kind of stuff that you have to deal with your custodian. Custodians are happy to start those conversations now. You're not likely going to get a lot of attention from your dealers. And I can remember someone else mentioned it earlier on the panel. I don't know who it was, but you're not going to get a lot of attention from your dealers right now, or frankly from your tri-party custodian on the ACAs right now, because that is what's consuming a lot of our time. There's not a lot of bandwidth for that, but that can certainly happen September, October time, once the September time is phased out. So, and then once that happens, then it's the actual physical implementation, the setup, the testing, all that kind of stuff. There's a lot of operational documents that are actually needed to actually set up an account later that aren't contracts. SSIs, tax documents, certificates of incumbency for signers, all of that kind of stuff needs to be collected before you go live. So there's a lot of work even on the back end. So education now, documentation for the bilateral documentation now and later into the summer and into the fall, and then hit the ACAs as quickly as you can, but also be prepared for those other operational documents that you need in the run up to phase 6. And also, when you're educating yourself, check with your custodians around deadlines, because like I said, they're not all the same. They're not all the same for a reason. It's not because one custodian is lazier than the other. It's because of the book of business that they're going to have to support going into phase 6, the heavy lift they're going to have. So don't assume that they're all the same in terms of deadlines. You know them well in advance, because you don't want those deadlines to sneak up.
I appreciate it. And you do not want those deadlines creeping on you. Definitely, it will be a bad thing. So we had some questions coming in already, flowing through the day. I'm going to start some of them. I'll float it to the panelists, whoever wants to take it first. If not, have to take them myself as well. So question came in is, should the SIMM be calculated pre-trade by the buy side or just before settlement? Any takers?
I think maybe I'll comment on that one, Ariel. Yeah, calculating the SIMM pre-trade is a good 102 approach, right? First of all, it requires you to have a SIMM calculation method. So the whole idea of just relying on your dealer's calculation is out the window at that point. But assuming you have that, calculating, a SIMM pre-trade, meaning if I do this trade, it's almost a what-if scenario. If I do this trade, what is the impact on my SIMM? Where is it most efficient for me to do this trade, with which counterparty, etc. That's a great practice, and we do see a lot of phase 5 and phase 6 clients talking about that, because the idea here is you're going to have to post more collateral than you had to previously. So doing that as efficiently as possible and keeping that number as low as possible is important, especially to the extent that you have a $50 million threshold on your SIMM. That's the other thing is, you have a 50 million threshold potentially with each counterparty. It's bilaterally negotiated, but the regs allow you to use that. If you can put the trade with a counterparty where you have a little bit of space, that could potentially keep you under the line. And let me just for a quick moment expand on that. We were talking about timing, obviously, but you heard Poseidon and Ted talk about get your docs in. That's important because you're going to get caught in a bottleneck. But there's a couple other aspects of timing that are not documentation related, and that's one of them. If you have your 50 million threshold, there was some guidance and relief given by the regulators a couple of years ago that said, if you're under the threshold, then you don't have to have your documentation finished. And a lot of people said, whew, that's great, now I'm free. But there's a small aspect of that that really needs to be considered. Once you cross that 50 million SIMM threshold, you have to be prepared to move collateral on that day. Okay, you don't start your negotiation, of your documents at that point. You have to be prepared on that day to move your collateral. So being able to monitor where you are against that threshold is absolutely critical. If you're approaching the 50 million threshold, you got to get everything in order, not only your documentations, but all your systems and processes for being able to calculate the SIMM, issue the margin call, respond to the margin call, and move collateral. It's all got to be ready on the day that you cross the line. So it doesn't give you quite as much relief as some people originally thought. And one other thing to keep in mind is we saw in an earlier poll, some of the participants said that they're not in phase 5 or 6, which is great. But keep in mind that even if you are not crossing that ANA threshold in time for phase 6, you still have to maintain below that ANA threshold into the future. Otherwise, you're going to get caught up in the regs post phase 6. So just as much as it's important to monitor your IM against the 50 million threshold, it's also important to monitor your ANA levels against that 8 billion threshold, because if you cross that line, you're going to be subject to the rules.
Thanks. Let me ask you just one follow-up question. Is it mandatory to calculate that SIMM pre-trade? It's good practice. Is it mandatory?
To calculate the SIMM pre-trade is not mandatory. In the US, as Poseidon mentioned, it's not necessarily mandatory for the buy side to calculate the SIMM at all, but pre-trade certainly not. In other jurisdictions, post-trade it would be, but not pre-trade.
All right. Another question, this is more market color, so probably more for Poseidon, for Joe. Legacy trades, those coming in, if there's any pushback from the sell side, any color you can give to the audience today?
Sure, I can take that one, Ariel. I think from what I've seen so far in terms of legacy trades, the consideration has been to the extent that it'll depend on the turnover of the book. And I think if you're a manager that has a large set of legacy trades, you don't want to bring them into scope, and they're long dated trades so that you think they'll stay there for some time. I think that's certainly a conversation to have with your counterparty to keep those out of the rules. Now there's an operational impact there, of course, because if you're keeping legacy trades out, but you have new trades going in and you're posting, you're repapering for those, there's going to be a dual process there. So from what I've seen so far, for at least for phase 6 firms, the decision so far seems to be mostly moving towards bringing legacy trades into the fold and not keeping them outside. But certainly that doesn't have to be the case, but I mean, maybe I'll turn it over to you, Joe. I mean, I'm not sure what you're seeing on this one.
Yeah, it's a little bit of a split, and understandably so, because as you kind of alluded to, it's a balancing act between cost and efficiency. If you bring all of your legacy trades in, it makes your operational process a little bit more efficient because you only have to calculate one portfolio. But then the downside of that is you're going to have to post initial margin on the full portfolio of trades, not just the trades that were executed since the effective date. And frankly, your counterparty is going to have something to say about that too, because all of the dealers, they have plenty of systems and processes in place to do that, to segregate those portfolios, because they've been doing it for a long time. If you on the buy side don't want to do that and you want to include legacy trades, that's going to have an impact on your counterparty, because now they're going to have to start posting initial margin to you earlier than they might otherwise have to. So that's an important consideration too when you're having those conversations.
So in the interest of time, because people are probably not going to their 10 a.m. meetings, parting thoughts, 30 seconds going in a row. Poseidon, 30 seconds, parting thoughts.
Parting thoughts, it's a complicated area. There's solutions out there. I think the lessons learned from the other phases are going to be really helpful, in particular phase 5, which is really where the hedge fund and asset managers have come in earnest. And so I think there's a process to be followed. If you're on track and you stay organized, it's not that scary. I don't think it's going to be as bad in terms of what people were thinking initially, like that you'd have to repaper all of your relationships and all that. So I think taking a level-headed approach and finding out what's most important and tackling it, I think is definitely doable, and something that people in phase 6 at least are in a good position to do right now.
Thanks. Ted, parting thoughts, 30 seconds.
Sure. Take advantage of your service providers, your custodians, your legal contacts, and industry associations. They're all willing to talk to you. Talk to them and test every assumption you have about what phase 6 is going to be. Timing, document load, tri-party versus third party, every assumption that you have, test it with the people that are willing to talk to you, that have gone through the earlier phases. Biggest challenges, biggest problems, biggest roadblocks in all the previous phases, I think, came down to incorrect assumptions. And so you test them, take advantage of the knowledge, you'll be in a much better place in phase 6.
That, and lastly, Joe.
Yeah, when we talk about UMR, it seems like SIMM always gets the headline, but as we've kind of discussed here, it's far from the only consideration. There's lots of other things out there. When you are subject to UMR, you're going to take a hit as far as having to post more collateral. But what you can do is there's plenty of things you can do to make yourself more efficient, to limit that hit as much as possible. So get your systems and processes in place to do that, and you can limit the impact on your liquidity, which is the goal.
From my side, my parting thoughts, it's a long process. People should start working on it, as the panelists said already. Most importantly, have some patience. It's going to be a lot of back and forth with your counterparties, with the custodian, tri-party conversations, what it's eligible, what's not. It's a patience game. You got a year to get it done, and I wish everybody, good luck and Godspeed on this. So at this point, I want to thank everybody for being here. I want to thank the panelists as well for their time, and have everybody a great day.
Thanks, Ariel.
Thank you.
Thanks, everyone.
Thanks a lot, everyone. Have a great day.